Before we get started, just a quick reminder that this explainer is for educational purposes only. It isn't financial advice and should always chat with a qualified professional before making any big financial moves.
Welcome. Today, we're going to break down a headline that you've probably seen 100 times. Interest rates are rising. But what does that really mean? What's the impact on you, on businesses, and on the economy as a whole? You hear that headline, right? And it seems like almost overnight, the entire conversation about money changes. Friends start talking about putting off big purchases, and loans suddenly feel a lot heavier. So how can one little number have such a massive ripple effect? Let's trace it step by step. Okay, let's start with the absolute basics. In simple terms, an interest rate is just the cost of borrowing money. You could think of it as the rental fee you pay for using someone else's money, whether that's from a bank or a credit card company.
Now, this cost has a huge say in how we behave with our money. When rates are low, borrowing feels cheap, right? It encourages us to spend, to take out loans for cars or homes. But when rates are high, borrowing becomes expensive. And suddenly, saving that money looks a whole lot more appealing than spending it.
To really see this in action, let's walk through a simple example. We're going to look at how a single change, the interest rate, affects a totally normal loan.
All right, imagine you take out a loan. With a low interest rate, your monthly payment is that first bar. Pretty manageable. Now, let's say the interest rate goes up. For the exact same amount of money, your monthly payment is now that second bar, noticeably higher. This is the key.
And let that sink in for a second. You didn't borrow a single penny more. The loan amount didn't change. The only thing that changed was the cost of that money. It just got more expensive to use. So, how does this more expensive money change things in the real world? Well, first, let's look at the impact it has on all of us as individuals.
When borrowing costs more, our financial thinking naturally starts to shift. That new car loan or that mortgage suddenly has a bigger price tag each month, so a lot of us decide to wait on those big purchases. We tend to be a little more careful with our everyday spending, and there's a much bigger push to pay down high-interest debt, like from a credit card. The whole balance between spending and saving starts to tip heavily towards saving.
Now, this effect doesn't stop with us. It keeps rippling outward, moving from individuals to the businesses we all work for and buy from. Because just like people, businesses rely on borrowing too.
For a business, the cause and effect here is very clear. Higher interest rates mean that their loans cost more. And when their loans are more expensive, it's just harder to get the funding for new projects or to expand. And that, in turn, slows down their growth.
So what does that look like? Well, a company that was maybe planning to open a new factory or hire a bunch of new people, they might suddenly put those plans on hold. New projects get paused. The company's whole focus can shift away from growth and towards just cutting costs to manage its more expensive debt.
Okay, so let's connect the dots. We have individuals spending a bit less, and we have businesses slowing down. What happens when you put those two things together? Let's look at the effect on the whole economy.
When both people and businesses pull back on spending at the same time, it basically acts like putting the brakes on the entire economy. There's less money moving around, less demand for things, and just less activity overall. And this isn't some accident. It's often the whole point of raising rates, usually to cool down an economy that's overheating.
You can kind of picture all the money in the economy as this pie, split between spending and saving. When interest rates go up, the reward for saving gets bigger. So naturally, the saving slice of that pie tends to grow, which means the spending slice has to shrink. And that rebalancing act is what slows everything down.
But it's not all about slowing things down. There's another side to this, and that's the positive effect that higher rates have on people who are actually saving their money.
Yep, for savers, higher interest rates are good news. They mean you get better returns on your savings accounts. You get higher yields on things like bonds. And this just reinforces that incentive to save money instead of spend it, because now your saved money is working a little harder for you.
So after looking at all of these different effects on people, on businesses, on the whole economy, what is the one key idea to hold on to?
I think it really comes down to this. Interest rates don't force anyone to do anything. They work by changing the cost of our decisions. By making it more expensive to borrow and more rewarding to save, they gently guide economic behavior on a huge scale.
And understanding that simple mechanism, well, it helps you see the logic behind the headlines instead of just the confusion. It shows you how the financial weather actually works, which leads to one last question. What other simple, powerful economic connections are quietly shaping the world around us every single day?